Good afternoon, everyone. Hopefully you can all hear me very well. Today we're going to go over basic market structure. This is another study hall session. You may have noticed there have been several study hall sessions in a row. The intent with these is to get as many members up to speed on what I'm talking about, what many are talking about, as quickly as possible so you can follow along. Of course, you can always just apply what you know and what you use. There's really no single way to trade the markets, but today's session is helping to reach that end of getting as many people as possible to either look at the market in a different way, and we'll discuss that in depth here, or to decide that it's not for them or whatever, but chances are you'll gain something from the time you'll spend here. Let's start by saying that derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. It's the goals for today are to establish a basic foundation from which we can put together the pieces of the market. Not the piece, but the pieces, like that, of the market generated information. So we're always trading on the hard right edge of the chart where the next tick is just not known. And we want to use whatever market generated information there is to determine to the best extent that we can what the probabilities are for the next play. We also want to cover the most common and important terms we frequently use. We also want to provide an overview of market structure and its implications on what comes next, and to try to set a standard for discussing the market. In other words, some language, some terms, the language we use and so on is very important so that you don't feel completely lost. Now, you can ask your questions in the GoToWebinar panel in front of you, the little chat box in front of you. I will not be taking questions throughout the discussion here. Yoda is here, as he always is, moderator, and he will do his best to address as many of them as he can. And if we have time at the end of the session, we'll address that. But this is going to be uninterrupted, which is, I think, is a better format for something that is not an AMA. Let's get started. So the most basic thing you should know, and you probably already do, is that the market is an auction. If you don't know what an auction is a process by which buyers and sellers, usually it's a two-way process, buyers and sellers come in with supply and demand, and we end up with one of those yield curves that you may have seen in an economics class where we determine what the best price is, where the most buyers meet the most sellers. That's the objective of the market. The sole purpose of the market is to publicly, efficiently, and transparently establish value. It doesn't, good point. It doesn't matter. This was the previous slide. I apologize. The screen was paused. These are our goals. As far as the market auction, it doesn't matter what it is we are trading. It doesn't matter if it's trading cards, trading stocks, trading cattle, cars, homes. Doesn't matter if it's businesses. It's still an auction. You are constantly negotiating by clicking, in this case, in the old days, by screaming across a pit, to advertise what you're offering or bidding for that market. Okay, and because it's happening in front of you, you'll get to see who else is offering and bidding on the market. So the market at its core, whether you're using moving averages, whether you're using fibs or whatever, it doesn't matter. It's just an auction. So this information that we're sharing today is applicable to you because you trade. Value is established when both buyers and sellers agree on price and trade a lot of volume. That's why sites like eBay exist, and many others. This is why your local farmers market exists. People bring their stuff down and they provide supply. You come in, you provide demand, and if you're in a non-North American market, there's some price negotiation. The market will continue to auction in one direction until it motivates the opposite side to step in. So as the market pushes higher, people like to say there are more buyers and sellers. Let's just establish right now as a fact that there are never more buyers than sellers. There are more aggressive buyers. In other words, they're willing to lift the next price to get in. There are more aggressive buyers, but for every trade, there's a buyer and a seller, period. In the futures market, the number of contracts that can be traded is unlimited. This is a very strong distinction in the auction that takes place in the futures market versus the auction that takes place in equities. Equities are limited by the float of the stock, and that float is controlled by the founders or the largest shareholders, and a lot of they get to have a lot of power on pricing. It's not as fair a process as in futures. In futures, there's continuous and infinite supply of buyers, contracts to buy and contracts that can be sold, and that's it's important. That's why in my opinion, it's a more fair or more transparent market. Items that affect how an auction works: liquidity and volume. Okay, so if a product has decent liquidity, somewhere between 500,000 and 1.5 million to 2 million plus contracts per day, traded per day, in terms of volume. And liquidity is how many contracts are available at each price. That's the depth. That's liquidity. When you have a product like RBOB, or maybe you're looking at crude expiration in December right now, you'll see that there isn't much liquidity and there isn't much volume. If for an auction to be orderly, you need both. You need volume to be present, just like we need a lot of samples to establish our edge. The market needs a lot of volume to really determine what value is. If the best bid and the best offer are 10 points apart in the ES, we really don't know what value is, because there's a huge gap in between that where the market's not participating. The product type, it's important to understand and know what is the asset driven by. Are they macro influences, sector influences, and individual underlying assets? So when you're trading, it really is important for you to understand what's driving this product, especially in futures, because they're derivatives of something else. You want to understand, what am I trading? The Russell 2000, you're trading 2,000 small cap stocks. The EMD, you're trading, what are they, 100 mid cap stocks. The S&P, you're trading 500 blue chip stocks, and so on. For crude, you're trading the actual commodity. That's why it's physically delivered, and so on and so forth. And you need to understand what are the influences on your product. Everything can be affected by macro influences. The most affected products by macro influences, fundamental influences, are things like the 10-year notes, the bonds, the dollar, the 6E euro contract, gold. Those are macro products and have macro influences. The influence on those products is pretty tremendous, whereas the S&P 500 can be influenced by something like a central bank changing its interest rate policy, but they are also influenced by individual stocks, like we saw with Amazon's earnings here. The market closing basically at the high tick and is reopening higher. So an individual stock can influence, if it's big enough and important enough, can influence the entire sector. The Amazon is not going to influence the 10-year notes directly. So you need to understand what the influence is. News events. A news event's important. That's why we track what's called the SOC. So that's a term that's in our glossary, and it's a term that you'll see often. SOC is the scene of the crime. This is an analogy to a crime that happens, like a murder, like back in the Sherlock Holmes days or whatever, that a crime is committed, and that's the point at which that particular flow got interrupted, and then with news events, we divert the auction, we interrupt the auction, and what often happens, depending on a type of news event, we often return to the scene of the crime and resume our auction from there. Okay? In either case, the natural auction process is interrupted because of news events. So those are the things that can impact market structure based on the auction. The fundamental items to know about your product. What is the underlying asset? Like I said, what events are of importance? Things like rollovers, earnings, major news events. Who are the likely participants in those events? Who's it going to draw in for your particular product when that event occurs? What are the product's tendencies? This is where we gather statistics, and we'll cover this also in a study hall session, which reminds me, the next study hall session next month is going to be a month from today, and it'll be on order flow. We'll look at order flow. What does it mean? What is it? What are we looking at? All that stuff. Look at Bookmap a little bit. But what are the product's tendencies? This is where we create those market cheat sheets. You have market cheat sheets at a member resource area. It's also in the market studies room. If you go to the top right of the chat room and hit the three dots and click on files, you'll see all the files that have been posted or images that have been posted, and one of them will be a cheat sheet for the ES that I posted earlier this week. Those describe the market's, the product's tendencies. Let's move to market structure itself, the technical structure of the market. The way I look at the market is to describe it in two ways. Price action. So I'm looking at what are the rotations. For example, harmonic rotations, the price action of the market, including the volume delta and so on. And then the other structure is the profile. And the profile comes in two flavors. The original flavor from like 1983 or 1982 was created by Peter Stadelmeier, who's a statistician, worked in the Board of Trade. He took and he organized the market into half-hour brackets, and he described how long a product spent in a half-hour bracket, and he assigned a letter to each bracket. Okay, so a market profile chart looks something like this. I'm just pulling it up. This is what a market profile chart looks like, in case you haven't seen one. Okay, so when we zoom into a market profile chart, it opens up a B bracket, okay, and every half hour we switch brackets. So if I split this profile, you can see that on this day here, let's look at today, it's most familiar. On this day, we opened right here at 2651, and we went down and up. That's the first bracket. So let's split that. That's the first bracket. Then comes C bracket. So that's from the first half hour is done, from 9 a.m. Central or 10 a.m. Eastern onwards until the IB is done. You have C bracket and C bracket pushed higher, and that gives us the IB, the yellow line here, the first hour, and so on and so forth. When you take those brackets, these are half-hour bars, and you scrunch them together, you adjust them so that they're justified to the left, you get what's called a market profile. And a market profile is essentially a histogram of letters. Okay, the reason he used letters is because they didn't have volume data at that point. They used tickets and actual handwritten tickets in the pit that were submitted every 15 minutes, and he would keep half-hour tabs on the market. And those are called time price opportunities, or TPOs, each one of these letters. So as we accumulate this histogram, we start to gather statistical information from it, just like we would from a survey of a population of exploring shoe sizes or something like that. Same process. The other way to do this is through volume profile. I started out with market profile. I became an expert at market profile. I could create the profile by hand, figure out the value area by hand without using a program. and all of that. And then over time, I recognized that I actually have tick data, very high quality tick data from CQG, and I started to use volume profiling, which looks like this, much more familiar probably. And volume profile does not care about time except for when it starts and when it stops. And the volume profile just accumulates how much volume in terms of ticks, how much volume occurred at every single price. And what that does is it tells us, okay, this is how much was bought and sold at 26.67. This is how much was bought and sold at 26.67 and a quarter, and so on and so forth. So we get a much more accurate magnitude of participation. So we know the price, but how much of that price traded at each increment, and that's what volume profiling does. Okay, so those are the two big pieces. Why do you care? Why should you care about this since you use fibs or some other thing? You don't need to organize things into a market or volume profile. What you need to do, in my opinion, in order to understand what the market's doing, and especially to trade larger size as you become more consistent and profitable, is to understand the auction. And the best thing that describes the auction, regardless of periodicity, so the volume profile and market profile, you can change your chart to whatever periodicity, especially volume profile. You can change your chart to a 1 minute or a 2500 volume based chart or 500 tick chart or whatever, 50 minute, 60 minute, 120 minute. It doesn't matter. The volume stays the same. It's describing what's happening at every price, not what's happening at every bar, which is what your normal volume bars at the bottom of your screen describe. How much volume went into each bar. I don't really care about that. What I care about is how much volume went into each price. And that's why the profile is much more important. And it ties in with this discussion about the auction because it tells us, it gives us a hard reading on how much the auction succeeded at each price. Okay. Is volume profiling or market profiling, I'll call them VP or MP, are they a trading system? They are not. Volume and market profiling, excuse me 1 second, I just need to cough. Volume and market profile simply organize the information. There is no system there, okay? So this is much like, you can't put a fib on a chart and say that that's a trading system. It's just a way of measuring, statistically measuring or mathematically measuring the extent of a move. So this is not a trading system. We can build a system around it, and I have, but it's not a trading system in and of itself. Why are we using one rather than the other? Like I said, I don't care about time. I generally don't care about time. Most of my charts are either tick charts, PNF charts, or whatever. I use a 15-minute just as a base, but to see multiple days. But in general, I don't care about time, and market profiles built on time. I find volume profiling to be much more descriptive of what's going on. And over time, and I used to keep both volume and market profile charts next to each other. And over time, what I observed is that the market tends to respond to volume better than time. So there are days when we could have a market profile point of control that's way up here. So this is 2668.75 on market profile, but on volume profile, the point of control is at 2666 based on volume. This is based on time. And on balance days, it could be even farther off, because the algorithm used to determine the point of control on a market profile chart is very different than the one used for volume, because volume is just looking at how many contracts. And it's very rare that two prices end up with the same exact number of contracts traded. So this is one of the bigger reasons why I moved to market profile, because it just made more sense to me, or moved to volume profile. What are the applications of either one of them? you can use them as a base for what is going on in general. Not only for today or yesterday, but you can combine them in what I call the microcomposite. It's a microcomposite is just a gathering of market profiles or volume profiles coming together. In fact, I want to stop saying market profiles at all going forward because I don't use it really. But the applications are really great. This is a statistical representation of the market. The value area of the profile is just one sigma, one standard deviation from the mode, which we call the point of control. It's one sigma from the point of control that tells us, hey, most of your data, it's 70%, approximately 70% of your data sits in this area here. That becomes our value area, and that's marked on our charts. So the applications are relevant to anybody trading any product, really. The only time a volume profile isn't telling you what you need to know is on a day like today where it's a trend and we don't really have value. The market, the computer calculates it, but there is no real value. Why profiling rather than fibs, geometry, oscillators, etc.? Why am I using that? Or why would I advocate using it? I don't. I advocate using it as a base to layer your fibs on top of it, to layer your geometry, to layer your Gartley patterns, your oscillators, whatever. In the end, you're trading an auction and everything else is built on price or volume, and the profile's giving you price and volume in one shot. Whereas fibs are looking at price, geometry is looking at price, oscillators may be looking at volume or price, and so on. The description of what's really happening is happening in the profile, and you can use everything else on top of it. So learning this can only boost your knowledge and your skill set, in my opinion. Why should this matter to you? Just what I said. It's a good way to base everything. So with that being done, understanding that the market's an auction, understanding the structures are built because of an auction process, let's get into the structure. And I'm going to focus on the ES because that's what most people trade. There are quite a few NQ traders, RTY, DAX, and so on, but let's do the ES, but the same information is applicable to the other markets. The first thing we need to look at to break down the information is, should we look at Globex data, which is the entire session, everything electronics trading on Globex from 6 p.m. Eastern when the market reopens all the way to 5 p.m. Eastern the next day. When it closes, it's operating on Globex. The pit session is a subset of that starts at 9:30 Eastern and goes to 4:15. The U.S. cash market, Wall Street, closes at 4. We go to 4:15 traditionally to give an opportunity for people to balance their hedge against the U.S. equity market for 15 minutes after the close. It also gives traders the opportunity to trade earnings, which you could not trade on the actual stock, but you can do it on the future, okay? Do we use Globex versus pit session details? The reason I only show the pit session, which is also called regular trading hours or RTH, is because that's where the real volume is. For a product like the ES, we have a distinct start and finish to every session. And there are other products that don't have that. Currencies don't have a distinct start and stop. A currency is traded 24/7 around the globe. Gold is another product that just goes from, New York to Tokyo to Singapore to London back to New York, and it's just, they're big markets that just trade it all around the clock, right? In that case, you're using Globex, you're using 24-hour session. But in the ES, the normal volume in ES, or the most common volume in the ES in the overnight session is around 110,000 to 125,000 contracts. The normal volume in the pit session is 1 to 1.1 million contracts. So the Globex session is representing about 10% of the pit session. But more importantly, in this particular product and most indices, the pit session is what has the underlying product substantiating the moves in it, because there are many systems that trade the futures contract fair value versus the 500 stocks or the SPX. So the 500 stocks need to be open to determine what that real value is, whereas Globex is trading in sympathy. Now, many will argue, well, wait a minute. Microsoft trades in Frankfurt. You can trade it around the clock if you want. There is the extended hours that you can trade on some of the US exchanges, stock exchanges. But really, look at the volume for those products as well. You would see that there really isn't much going on until the actual market opens. Now, over time, this is shifting, and it's continuously shifting. The markets, the trading is becoming more and more global, despite efforts to reverse that. It will never happen. It'll continue to be global, and Globex will start to get more and more volume that blends into the pit session, and at that point we'll make that transition, right? But right now I'm looking at the underlying product. The underlying product doesn't really trade outside of the pit session, so I don't care about Globex once the pit session opens. Now I'm going to add a note in here and say Globex is important in my preparation process. Before I do the trader bite or before I do my plan for the day, I'm looking at Globex. I'm looking at what it has accomplished. So we don't just throw it out. It just isn't something that matters to me once the pit session's open. The next thing we're going to look at is opening types. So you'll hear me mention the opening type. We'll talk about the opening swing, initial balance, and range extensions, the day types and their statistics, the range extensions. Oh, I put that in twice. I actually moved it. I moved it and I didn't delete it because it belongs with the initial balance. VPOC movement, what that means, and one tick failed auctions. So let's get started. We'll talk about Globex versus pit in detail. Opening types. So these are all in our glossary. To find our glossary, it's at convergenttrading.com, not the member site, but the public site, convergenttrading.com. At the top, there's a menu item that's called useful info. In there, you'll find the trading glossary, and it'll have the opening types in there. We're going to look at the opening types in order of directional trend, okay? The most common opening type is an open auction in range. You probably hear me mention that, cite that more often than anything else. Open auction in range simply means that the market opened inside of the prior range, and you can further describe an open auction in range by saying it's an open auction in range in value. So if we have a balanced day, something that's a profile that looks somewhat like a normal distribution, and let me explain to you what a normal distribution is. Let me get my trusty pen. Okay, yellow's the color. So a normal distribution looks like this. Okay, when we take a population that is normally distributed, we tend to have nothing at the tail, a lot in the middle, peaking about the center, or what's called the median, and then tapering at the bottom. Shoe sizes, heights across a population of high schoolers or whatever. If you go survey, you'll find that most distributions fit this. Okay, theoretically. In real life, distributions are skewed to one side or the other very often, especially in the market. But this is what a normal distribution is, and this is the value area of a normal distribution. So this, the volume that the area or the volume that occurred in here represents what's called 1 sigma, okay? And that's equal to 68 point something. We'll call it 70% of the data set, okay? Everything outside of it, so everything that falls outside is 15% below, 15% above. I'm drawing this with a mouse, so it's really not pretty, but that's a normal distribution. When the market opens in what we would call a balanced profile, and it opens outside of value, value being 1 sigma, this area here, we call it an open auction out of range, out of value. When it opens inside of value, we call it an open auction in range, out of value. And this would be called open auction in range, in value. I won't get caught up about this. What you need to know is the market opening in range or out of range? When it opens out of range, it is out of balance, and therefore that has some implications. Okay, so open auction in range. Open auction in range is probably one of the most common auctions. It just means that in the overnight session, not much happened, and so the market did not have to reprice value for the session. Okay, so the expectation here, from least likely to most likely to trend, with an open auction in range, you are least likely going to have a push, a directional push. So we expect chop. It's basically saying the market is accepting yesterday's range or the prior session's range, whatever that is, and it's opening inside of it. So everything, there's peace. Okay, everything's in balance. Open auction out of range is when we open out of range, just like we did today, and then we start to trade back and forth, back and forth. Why is this important? Why do you care? It is a big piece of identifying where the open is. First of all, is the open out of balance or imbalance? Is it inside of the prior day's range or not? And what happens after the open? So if we look at today, we opened out of balance, so out of range, and we traded sideways and sideways and sideways. That's an open auction. It means both sides are equally trading, auctioning back and forth. Okay, so that's an open auction. It's also, even though it's an open auction, because it's out of range, there's a tendency for the market to tip directionally like it did today. So like I narrated today, in our chat room, look out. If this doesn't push lower, if it's failing to push lower, look out, because it's likely to go the other way, and if it does, it might have some push to it. Open rejection reverse is a market that opens and it drifts. So an open rejection reverse might look like we open. So this is not a good example. Let me back up a few days and show you an example. Here. So this isn't an open auction, open rejection reverse, but let's say that the market had a directional close here, and then it reopened the next day, and it just continued to drift. It continued this auction that was interrupted by the close, and it just opens and it just kind of moves directionally, not very strong, and then all of a sudden, in the middle of nowhere, we have a reversal, and a reversal has some driving power behind it. An open rejection reverse tends to be listless, or tends to drift before direction begins. Okay, and it is the third most directional opening type that there is. Sorry, I keep having to flip back and forth because I'm using one monitor for this display. Open test drive is much more directional. An open test drive is a market that opens, tests a known area. So an open test drive in this situation, and we've had one recently actually, can't recall when, but let's say the market opened down here. Market tests, so it goes below yesterday's low, and then you have a drive. So this is an impulsive move, and you would have a big rotation, and you would have good delta or volume coming in. That's an open test drive. That is a move you do not want to fade. So in general, an open test drive, it checked in one direction and it turned and it ran in the other direction. This looks like an open rejection reverse, but an open rejection reverse is drifting, kind of not having accomplished an auction goal, not having tested a specific area or specific price before it reversed. It tends to have less of a drive than an open test drive. An open test drive is a one-tick failed auction. Okay, we'll talk about that in a minute. A one-tick failed auction is an open test drive, if that happened at the open. It's a directional move. The last and most important but least common is an open drive. This is a market that has participants coming in at the open and it just runs. It just runs. And this is called an open drive. It generally has very good directional discovery, so it moves through prices very swiftly. It has very poor rotational discovery, meaning it doesn't pull back very much, and has very good volume backing it up. An open drive, if you detect an open drive, you trade in that direction. Essentially, if you can disable the button that allows you to go opposite the opening drive for that day, you should disable it. Do not fade an open drive. The last thing I want to say about the opening types is they are very important for detecting the participants. Here we have small time frame traders or short time frame traders and intermediate time frame traders. Okay, so these are generally day traders, swing traders, and so on. They're not really directional. They don't have a directional bias. These guys, open auction out of range, tend to have the same, but there's an imbalance. So there's a tendency for an other time frame, an OTF, a much higher time frame trader, to step in and push the market directionally. So this is a lamp with a small base that tips over, that has a lot of length, that tips over very quickly. An open auction is one where there's great opportunity once the break happens, just like we had today. That's why I kept talking and talking and talking on the audio updates. Open auctions are what really kill traders. Open drives are what really kill traders. Traders tend to want to fade an open drive or an open auction because they think, oh, the market's trading in balance and so on. So we're going to go back and forth, back and forth, back and forth, when actually it opened out of balance and the OTF is waiting for a directional move. And when it does happen, it pushes. Look at today's action. Open rejection reverse. This has intermediate time frame and OTF and a high time frame, meaning institutional big money coming in. Okay, terrible writing. Okay, OTD, heavy directional OTF, lower intermediate, and in an OTD, generally it's a short time frame that is fueling the moves. That's continuously extending and exaggerating the moves. It is the day traders fading the OTD direction that are continuously pushing the move farther than it normally would. Same thing with an open drive. An open drive almost purely OTF, almost purely high or long time frame traders in here. Why do we identify the opening type? It is another opportunity, one of the earliest opportunities for us to identify the kind of day we have. Opening swing. What is an opening swing? An opening swing simply seeks to identify where the first buyers and sellers stepped in. This is just a way of marking where the initial turn came in. So on a day like today, on this day, this was Tuesday, we opened down here at 81. We went to 82, just 4 ticks. Then we went to 77. Okay, so initially the opening swing is right here at 82. We don't have any other information other than, hey, this is when sellers stepped in. The opening swing is not constrained by time. So we're not looking for 5-minute opening swing or 15 opening swing. That's called an opening range. I don't believe in that either. I find that it's very random. So an opening swing is basically an art in a way to determine when did the buyers get exhausted and the sellers step in, what was that price, and that gives you the opening range, the opening swing high. And then the opening swing low is when did the sellers get exhausted and buyers step in. And in this case, it would be 26.77. So we mark these two lines. These are actually my opening swing lines for today. Okay, we mark these two lines and then we start to compare the action. When you have a swing that extends and falls through, then you can extend the opening swing to that high. This is a much more distinct opening swing high than this one, which was a bar that opened, went up 4 ticks, and then all of a sudden sellers came in. It wasn't really an auction, a complete auction. So I tend to move my opening swing. If it happens within the first 20 minutes or so, I'll move it to mark that high. And oftentimes, because of the nature of the ES, the opening swing, high or low, will tend to coincide with the initial balance, high and low, which I'll cover next, I think. Yes, I do cover it next. So let's look at today real quick, just to put that in perspective. How did the opening swing look today? Market opens, 51, sells off. Goes down to this 46.50, 26.46.50. Then we get a bounce, okay? And then we extend the opening swing low. So this is the opening swing high, 26.51.75. And then we keep those lines on here for the rest of the session, and we look for how does the market behave around the opening swings. If the market opens and it starts to push back and forth through the opening swing. So let's forget that for a moment, because I don't have an example of it. Let's forget that the opening swing was down there, and let's just say the opening swing was up here, just where the IB is. Okay, let's say this wasn't the first 45 minutes, this was the first 5 minutes. Okay, and so we have a nice opening swing here, and the market just trades inside of that opening swing and is stuck in that opening swing and keeps coming back into the opening swing. And it just so happens that the point of control, the mid, the VWAP are all inside of the opening swing. Then we start to look at the market as an outside-in trade, which means that it's a mean reverting trade intraday in our small time frame. We're looking for extensions outside for them to fall back in with a higher probability than for the market to continue. If the market's not able to leave the opening swing behind and move directionally, then what you have is an outside in or a mean reverting market. If we open and we push through the opening swing and are not able to recapture it earlier in the session, it's giving us another clue, just like the opening type, it's giving us another clue that we have a directional market, and so we keep our hands off the opposite trade. Okay, I hope that makes sense. Let's bring back our slide. So that's the opening swing. Again, it's not constrained by time. It's simply defining the high price and the low price early on in the session. Initial balance. Initial balance is very simple. It is the first hour of trading, of actual trading, when the underlying asset's in play. So for the S&P, the initial balance starts at 9:30 Eastern and it stops at 10:30 Eastern. It's the first hour. For crude oil, which opens at 9 a.m., the pit opens at 9 a.m., the initial balance opens at 9 a.m., starts at 9 a.m., and it ends at 10 a.m. And whatever that high and low of the first hour, that's what's called the initial balance. It's very, very simple. Why is that important? Because if you look at a volume chart of any product, you'll find that pretty much somewhere around half of the volume for the day will occur within that first hour. Some high probability, not half, but some high proportion of it. So let me zoom this chart. And for right here where it says, you see this vertical line, this vertical gray line, that is a new day. And you can see that the pattern for how we trade is peak at the open, fall through lunch, peak at the close, peak at the open, and this is the black here is the actual median or mean, the average. Let me see if I can hide that. Let's hide that. There. You can still see that we open, we drop off, we peak up. We open high, drop off, peak up. Open high, drop off, peak up, and so on. And what we're identifying with the initial balance is the real business, the market on open business that occurs usually in the first hour of trading. And it generally sets the mood for the day. And we're saying, okay, whatever business took place in the first hour is likely to define what we do for the day. And if we extend or breach that first hour's business, high or low, then we have an action, an aggression in the direction of the breach that is pushing the high or low for the day. For the S&P, around, I don't remember these statistics, like 60 or 67% of all days tested put in their high or low at the initial balance. So approximately two-thirds of the time, the S&P will put in its high or low within that first hour. And when the first hour gets breached, we take note, and that breach is called a range extension. So that brings us to the next topic here, which is a range extension. And a range extension is very simply a push of 2 ticks or more in the S&P, and it's a lot more than that in thinner products, but it's a push of 2 ticks or more outside of the initial balance. And that's the aggression I was just talking about. It's basically the market pushing in one direction after establishing, okay, these are the limits for the first hour. As soon as we extend those limits and start to auction outside, we have a range extension. The range extension defines the kind of day we have. We'll go over day types next. So a range extension on one side that pushes by a small amount and falls back in is considered a normal day type. If we have a range extension on both sides of the, if we have a range extension and a small break on the other side, we have a neutral day and so on. We'll cover that with the statistics associated. But understand, when we're talking about a range extension, we're basically saying that that important first hour of trading has been transgressed against or has been breached in a direction. Okay, that's what a range extension is. Next, we cover the day types. Day types, so these are stats including today for the last 4 years, 1,025 sessions. Well, I'll go over the day types, and these can be detected intraday sometimes, like a neutral day is obvious when it happens intraday, but most days we identify the day type once it's done, and the day type is very important for informing what the next day is likely to do depending on where it opens. So again, this is a market structure element that describes our foundation. For those of you who heard me talk on Tuesday, was it? In the impromptu about building a foundation, what boulders go into your foundation? What are the big rocks that go into your foundation versus the little rocks, the opening type, the opening swing, the opening location, the opening type, the opening swing, what the initial balance has done so far, the size of the initial balance, and if it has been breached. Remember, there's a probability on the initial balance that it would be breached about 96% of days, okay? or 97% of days, and so on. And so as we bring these pieces together, it informs us, it gives us a better and better understanding of who is likely to be in control. And that's the big piece we want to get to at the end of this talk, for which I have about 10 minutes left. But going through these in terms of the least directional to the most directional, the least directional is what's called a non-trend day. A non-trend day is a day that has a small IB, very small range, unusually small range, and it happens only 3.1% of the time. This is the kind of day we get, the Friday after Christmas or something like that. There's nobody in the market, very poor volume, there's no direction, and it just doesn't go anywhere. It's not even able to breach the IB, which is actually smaller than normal. That's a non-trend day. It occurs 3.1% of the time. A normal day is anything but normal, unfortunately. A normal day is a small IB that pushes through on one side by a small amount. So we have a range extension that is very small on a small IB, and the market's also just drifting sideways. Occurs 4.1% of the time. So far we've covered 7.2% of all days. A neutral day is the next most balanced day, or the next less balanced day. So we go from tight, non-trend, to balancing normal, to less balancing neutral. Why is it less balancing? Is because the market had enough power to push through one IB and then to push through the next IB. Okay, that's what a neutral day is. When both IBs are breached, not touched, breached. In other words, it has to go through by a tick, and then we have a neutral day. Neutral days occur 15.8% of the time. Neutral days follow each other approximately 26% of the time. So we have a neutral day. There's a 26% probability of a neutral day begetting neutral, or neutral having another neutral day behind it. That's neutral is generally a clear indication that the market is fighting for value, and it's doing it on both sides, but it's still balancing. So neutral days tend to close inside or in or near the initial balance. Normal variation is the most common day. Normal variation, or variation of a normal day, is a day that has a good sized IB where the market pushes directionally in one direction, but it's rotating and rotating. So it's discovering price in a very methodical and successful way. It is not balanced, but it breaches directionally, but it's doing so in a two-way market. So it might rotate 5 points, pull back 3 points, rotate another 4 points, then pull back 2 points, then breach again by 5 points, then pull back 4 points. And it's going back and forth, back and forth, back and forth. It never crosses 1.5. Well, it hardly ever crosses 1.5 IB extension, and it occurs 52.6% of the time. This is the most common day that we have in the ES, okay? Neutral extreme is a really great thing to have. A neutral extreme market basically caused a lot of damage to one side or the other. This is a market that pushed in one direction. This is a market that pushed in one direction, and then it trended in the other direction very strongly, okay? And it generally finishes at the extreme of that day. So what you have is a balanced day neutrally that breaks, and then we turn into a trend day, and we go in one direction all the way through, and we close in the quartile of the range. In other words, the upper 25% of the range or the lower 25% of the range. This tends to drift into the Globex session. We tend to drift. In other words, we tend to continue the move in the Globex session, and we tend to balance outside the next day or push to continue the move the next day. So neutral extreme gives us some very good clues as to what's going on and that there is a clear imbalance. A trend day is very directional. A trend day can come from an OAOR open, like we saw today. Today's a perfect example of that. Or we open, we have a very wide IB because the market is just immediately repricing value. It's just, it opens, it maybe has 2 ticks in one direction and it just takes off in the other direction and never looks back. Very poor counter rotations. In other words, it just never balances. It never turns back on itself. It doesn't really give us a good chance for a pullback. You'll likely never see VWAP. Once it takes off, you'll likely never see mid. You'll see the point of control shifting throughout the day, upwards and upwards and upwards. You'll have a lot of low volume nodes. And you'll have a lot of high volume nodes just extending throughout the day. Why? Because the market is discovering price very, very aggressively and it's not finding balance. And generally it extends to or beyond 2 times the IB. It just makes double the extension. The ES over the last 4 years has trended about 13.9%. An interesting note to have here. Over the last 4 years, it's trended 13.9%. But if I look at the last year, it's trended more like 30%. I think it's 30.5% of days tested. It's trended that much. Recently, trends have been dominating much more than they used to, especially since the November 2016 election. We've had a lot of trend days, just extraordinary amount. Okay, I'm running out of time here. VPOC movements. This gets asked a lot. VPOC shifts are simply an indication of the market trading enough to cause a shift in what is the most valuable price or the most traded price. And what a VPOC shift is signifying, like this day here, we had a VPOC here. Then we shifted the VPOC there. And then we shifted the VPOC all the way down here. And then we shifted the VPOC back up to there, and that's where it finished. What the VPOC shift is saying is if the market opens like this and it starts to trade, so VPOC's right here, it starts to trade, and it trades enough that it has more volume here than here. What this is saying, and you can probably guess, what is a VPOC? Good question. A VPOC is the most traded price by volume. Okay, so it's in statistics it's called the mode. It is where the most trading happened for that particular time frame. Okay, that's what a volume point of control is. The point of control is the point at which the auction traded the most. Once we shift and then we have enough volume down here for the point of control to shift down, what could that imply? A couple things. If a VPOC shifts down, all that's saying is the market has moved low enough to entice more aggressive buyers to participate, right? And if there are more aggressive buyers participating and sellers are still participating with them to create this VPOC shift, in other words, create that volume, it's simply saying, okay, we've got energy here. So we had energy at the top. We created that VPOC at the top. So now you got a whole bunch of people who are long, a whole bunch of people who are short, right? A whole bunch of people who have bought, a whole bunch of people who have sold. The market started to push lower, like you see there, and a lot of those people who are long are now being pushed out, and they're becoming what? Sellers, and they're pushing, they're dissipating their energy. They're creating that capability, the energy to push the move far. And that's why when we are in balance and we're compressing a lot, I always warn, hey, be careful. This is coiling. It's like when you take a coil or a spring and you squeeze it and squeeze it and squeeze it and squeeze it. The more you squeeze it, the more energy, potential energy it has. As soon as you let go, that potential energy becomes kinetic energy, and the spring, boop, bounces very, very hard. And so that occurs with volume. This is the key to volume profiling, is that we're seeing where that compression is, where that energy is stacked. Once the VPOC shifts down and we see that more energy is being stacked here, it doesn't tell us that it's going to continue. It doesn't tell us that it's going to reverse. What it tells us is to watch out. We have another spot where there's a lot of coiling and enough energy. So what's important about a VPOC shift is to recognize that it happened, and equally importantly, what happens afterwards. Does the market continue? If the market continues lower, you better find a place to get short, because what happens is a lot of those buyers who participated in here to create the volume are likely to become sellers and push this even further. So let's say an auction is blunt, okay? So all morning we traded back and forth, or it's even like yesterday, it was square. And so we have a large range of prices that are being traded. They're trading the same here, 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 here. This is an uninteresting auction because they're accepting, there's a consensus here that all of these prices are equally as valuable because participants are willing to trade almost equally across the entire range. There's no imbalance here. Okay, we haven't really built that powder keg of energy. Now, take that and let's say an auction looks like this. Okay, there's your VPOC right there. Okay, highest volume price. This is much more interesting because now you can define a pretty tight risk limit, knowing that there's a whole crap load of energy in here, and once it tips, it extends quite far. Just observe this for yourself. When you have 2 days that have the same or about the same point of control, those are days to recognize. When did we have that? We had that right here. Yesterday and Tuesday had 2 points of control right on top of each other. It's this maroon line on my chart. That's the point of control for this day. That's the point of control of this day. This was 26.33, I believe, and this was 26.32.5, basically overlapping each other. That's a lot of energy. I'm expecting the market to go out of balance once it's been balancing like this. And that's what a VPOC shift does. It feeds the next move. It doesn't in and of itself tell you what's likely to happen. This could just as easily have enough buyers in it, or more aggressive buyers that outpace in their aggression the sellers, to the point that it starts to squeeze up, and as soon as it gets into the thin portion of the profile, very quick to push higher, because those sellers down here are now becoming buyers and are pushing the market up. Okay, so that's what you need to know about a VPOC shift. A few things I didn't cover, which you can look up in the glossary. What is an HVN? What is an LVN? I decided not to spend much time on that because that's simple stuff that you can read. The biggest HVN by volume is the point of control, right? Those are the same thing. And the price that's traded the least, that has the least volume or the least accepted price, why doesn't it have volume? It doesn't have volume because participants did not want to trade there. And that's called a low volume node. And they create the high volume nodes and the low volume nodes create a very clear distinction as to where the market, what's the sentiment? How popular are those products? That's basically what that's saying. A one-tick failed auction is the market moving in a direction. We had one recently, a very clean one. Where was it? Right here. Very clean. That's a one-tick failed auction right there. Okay, so the market opened, it pushed lower, put in a low. That low is 26.67.75. And then it traded in the middle, and then it pushed lower again. And after making all of this effort to push down from about 26.75 all the way down to 26.67, all it could do is push that low by a tick. One tick. And what this is is disinterest. So the market pushes through a known barrier or a known mark, and the best it can do is muster one tick. If you were someone who is looking to buy and you have a one tick failed auction low, then and the market just springs up, now you can buy with confidence. Why? Because the market, if there was any interest to sell below that IB low that got broken by a tick, it would have triggered stops, more sellers would have stepped in, and it would have run through. And because it could not, the buyers step in with more confidence. So a failed auction is simply created from two things. One, a known point. So yesterday's low, yesterday's high, an IB low, IB high, an opening swing high, opening swing low, that sort of thing. You can have a one tick failed auction on pretty much any price that has already auctioned and is very distinctly a high or a low, and the market comes along and it just tests it, but the best it can do is push it by a tick and spring the other way. That's a one tick failed auction. One tick failed auctions behave like an open test drive opening. It generally, the move in the opposite direction has a driving component to it, and it tends to push people out very quickly. And you see that here. It pushed one tick, it lingered a little bit, but then you get this explosion upwards. And that's just a clear example of that. The last thing I wanted to talk about today, before I let you go, what is this all about? What is the point? You could put a lot of mathematics on your charts. You could put a lot of lines and triangles and patterns and all this stuff. Really, it's about something more simple. Trading, as I've said for years and years and years publicly, and longer, 10 years longer than that, privately to my traders and so on, it's simple. Trading is simple. It is just a perception of future value. That's it. We're trading against a perception of future value, and as day traders, we use probabilities. We try to stack probabilities in our favor, and we're trading from that point of view with discipline in order to make a living. That's the story, okay? It is hard. It's simple, but it's very hard to do because a lot of things get in the way of the simplicity of the market. So when you look at basic market structure, the thing that I'd like you to leave with here the most is one, it's an auction. I don't care what you've got on your charts. I don't care what you're trading. It's an auction. If you didn't get that impression yet from this talk, you might want to read up on it or talk about it some more. It's an auction, period. It's a mechanism for discovering value, period. The market wants to be in balance all the time. It does. So if we look at a day type chart, the day type for trend was what? It was 15%, 15.1%. So 85% of the time minus neutral extreme. Let's call it 70% of the time. In fact, what am I talking about? Let's just pull it up real quick. So if we eliminate neutral extreme and trend, all of these other days are balance days. Okay, so if you add these up, so if we take off 10.5%, so 23, 24.5%, so 75% of the time of all days, the market's seeking balance and is in balance. The 2 days that are not are neutral, extreme, and trend. And that's its purpose, is to be in balance. So auction seeks balance, know that. So if the market's in balance, you want to trade from the outside in or whatever. But the other key element that you need to become very, very comfortable with if you're not consistent or if you're looking for a better way to trade, and I'm telling you this from the perspective of someone who is going to trade 50 lots and 100 lots and 200 lots someday. So it's all well and good to trade a 1, 2, 3, or 6 or 10 lot using some moving average. But once you get into the bigger sizes, you are forced into the type of thinking where we have to look at the market as a narrative, as a story, as a contextual read in order to put that size on, in order to scale into a position that's 100, 150, 200 lots. Okay. And in order to do that, one, understand the auction. Again, I'm going to say it. Second, understand who is likely to be the participant. The importance of the participant type is really high. Who are you trading against or with? Who is likely to be participating in this auction with you? An open auction in range probably has short time frame traders, maybe some intermediate time frame. If that's the case, then your daily levels are likely to be respected. So yesterday's high, yesterday's low, yesterday's close, yesterday's value high, yesterday's value low, yesterday's point of control are likely to be areas that you can participate in. But if it's a type of day that's out of balance or becoming out of balance, like an open auction out of range, open rejection reverse, open test drive, open drive, that's an intermediate to high or long time frame trader participating. A long time frame trader, and we've got guys in our membership who used to be or are fund managers, for example. I think there's 7 of them. These guys don't look at the market as, oh, I need to get in and I need to look at order flow. They couldn't care less. They're trading in a 30, 40 point range, right? They're putting on a position. When I go to the CTAs, the hedge funds here in Chicago, these guys are moving a lot of volume. And so they don't care about yesterday's high or low. They don't care about the IB. They don't care about the mid. And if you don't identify who's likely to be participating and you stand in the way because you think it should stop in the mid or it should stop at some level that you put there from last week, and you didn't correctly identify the opening type, the day type that's developing, and so on, then you are likely to lose and lose continuously. So at the end of the day, you really want to you really want to understand who you're participating with or against. Okay, I will participate against short time frame traders. I will participate with intermediate time frame traders. I would love to participate early with long time frame traders, but on trend days, I generally don't participate at all. But trend days, as we saw in the slide above, represent 10%, 13%, 14%. So I'm okay 85% of the time, right? Recently, it's much higher. So understand that. So that's really the goal behind this conversation, the biggest goal behind this conversation, and understanding basic market structure. And that's what I wanted to cover with you, and I'm 12 minutes over my time. I think we're going to cut it off here. Any questions you have, plop them into the lounge in the chat area, or catch me in the next AMA, and I'll leave it there, okay? So today should have given you a little more clarity as to why we talk about volume profiles and why we structure the market and the information the way we do, because our goal as an entity, Convergent, and your goal as being a member is to get a much more holistic view of the market as opposed to a buy and a sell signal or following my trades as I post them. I want you to not need me eventually. Okay? Sounds like a bad business plan, but it isn't. Good luck.